Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at three top stocks to consider buying in July and holding for long-term growth. Those three stocks we're going to dive into today are Align Technology, Mastercard, and Intuit. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into three stocks to consider buying in July, we're going to do a quick market overview with the end of the second quarter happening today, Thursday, before we head into July. So last week's bounce appears to have been, at this point, nothing more than a relief rally within a broader market downturn. So the S&P 500 posted that big 6.5% jump during that holiday shortened week last week, following what was its worst week since the initial COVID sell-off in March 2020. The Dow and the NASDAQ also rallied alongside the benchmark, but the market fell again in the last week of June to end at the second quarter on a pretty sour note, though we did, recording this right near the end of the trading session on Thursday, we did bounce off the lows from Thursday, which was pretty solid to see, but still nonetheless, the S&P 500 is down essentially just over 20% through the first half of the year, with that now marking the worst first half since 1970. And finding any prolonged upward momentum might prove difficult until inflation finally starts coming down. The Fed has made it pretty clear that they're going to keep their foot on that interest rate pedal until the central bank sees a sustained period of prices cooling and coming down. So thankfully, though, there are some signs of inflation cooling. From 40-year highs, the housing market's cooling. Consumer sentiment's now at record lows. And if consumers are feeling rough about the economy, and that really finally starts to show up in like real data in the coming months, it could go a long way into cooling prices since the U.S. consumers account for about 70% of the economy. The market's currently struggling, though, with the seemingly contradicting data of various people on Wall Street and the data as well of some people saying we're in a recession, some people are saying we're not. So we will hopefully get some more clarity with the second quarter earnings season, the June CPI print, which is due out in the middle of July, actually the same week that the busy portion of second quarter earnings season kicks off. And then we have the Fed having its next meeting at the end of July. So July could be a big month in terms of where the market's going to go for the end of the summer. And then obviously after the summer, things could shake out more as consumers maybe slowly stop spending after they're returning to their normal lives this summer, maybe after people didn't do much of the last two summers. With that said, it's obviously hard to call a bottom or know what's going to happen in the near term, and it's really impossible, besides retrospect, calling the exact bottom. But if you're a longer-term investor, now is certainly a solid time to consider, especially with such downbeat attitudes. Downbeat attitudes around the board are often a good contrarian buying signal because people are often very bullish at the top of the market and really bearish, which in times that turn out to be, in retrospect, the bottom of the market. We should also note that history is on our side at the moment in terms of these big downturns to start a year. So when the S&P 500 falls at least 15% the first 6 months of the year, which it did in 1932, 1939, 1940, 1962, and 1970. It has risen on average 24% in the second half, and this is according to some Dow Jones market data. So that's a positive sign. And we should also stress again that the market has recalibrated things in a big way with the rising interest rates. We've pretty much cooled down and chopped off all of the COVID gains, especially if you look at price earnings ratio. So if we look at forward 12-month price earnings, the S&P 500 trading at 16.4 times forward 12-month earnings, which is below its COVID lows and right down near its lows from late 2018. So that's a solid sign that valuations are coming down to reflect this new interest rate environment that we're in and seeing all the froth of the last 2 years get run off the top. So with this in mind, we're going to take a look at some stocks to consider buying that are at nice enticing levels that are long-term plays. If you're planning to hold them for years and years to come, you don't need to bother trying to time the market as much. So the first of these names of the three stocks we're talking about today, as I mentioned, is Align Technology, which trades the ticker ALGN. So Align Technology It's most known for its Invisalign system that really helped change the broader orthodontics industry forever. So it's those clear aligners that are true alternatives to traditional metal braces that have continued to grow at a rapid pace since its founding in the late 1990s. Its innovations and success have spurred other clear aligner firms to enter the market. So that's the likes of Smile Direct Club, Candid, many others. So despite that competition, Align has remained really the dominant force in the clear aligner space, and it's poised to continue that reign going forward. So Align offers people the ability to straighten their teeth and correct other orthodontic issues in far less visible, clunky fashion, and often far more affordable than those traditional metal braces. So it's these clear aligners. Probably sometimes don't even know someone's wearing them. And its business model also includes tons of proprietary technology that helps scan people's teeth, those digital teeth scanners, and beyond that, it's also part of it's ever expanding. It's just growing its end-to-end solutions to try to just become even a more wide-ranging orthodontics company. So Wall Street and patients also love that it works hand in hand with dentists and orthodontists who actually digitally scan the people's teeth in person and walk them through the entire process. Many of the newer competitors are focused more of on an e-commerce approach where they mail you things and you take moldings yourself and send them back in and have it all come through the mail. And obviously people like getting packages and stuff shipped, but maybe something as important as fixing your teeth and messing around with your mouth, something people don't necessarily want to do all through the mail. So the company's also expanding internationally, which is key, and a newer growth market that they're expanding really successfully in is the teenage demographic. So for now, most of their business or up until now, recently, more of their business had been people who were wanting to correct their teeth later in life and didn't want to have, say, be 25 or 30 or 40 or 50 and have metal braces on. So they wanted to have these clear aligners or maybe fix problems from when they had braces when they were younger and they forgot to wear the retainer and maybe correct smaller issues. But now they're gaining some traction with people who are first-time orthodontic users. So that teenage demographic, which could be huge if they're able to convert more people who then never get traditional metal braces. So the company has helped treat nearly 13 million patients as of the end of the first quarter of 2022. And it posted an average revenue growth of about 30% over the trailing 6 years. It was boosted by 60% growth last year as people rushed to spend on personal care and everything, boosted by some government stimulus and just the booming economy and everything. People were feeling good. They wanted to get out there and fix their teeth. Maybe they'd been thinking about it for years. But also that 60% growth boosted it to 30%, but it also only grew by 3% in 2020. And it's posted double-digit sales growth every year since 2009. Until that 2020 pullback, but then it bounced back in a big way in 2021. So all in all, the company's grown really steadily on the top line, and then the company posted adjusted earnings growth of 114% last year to get up to $11.22 per share. And the company has seen its stock price fall, and they've lowered their guidance based on as everything economic sentiment goes down, consumer sentiment goes down, people are going to then maybe not spend a couple $1,000s on fixing their teeth. They're going to wait until they feel a little bit better about the economy going forward. So our 2022 estimates are calling for about 7.3% revenue growth and for its earnings to slide about 10% compared to that massive growth last year. But then if we look ahead to 2023, we're calling for another 20% top line growth to get above $5 billion for the first time, and then another 27% adjusted earnings growth. And as I said, the company has seen its earnings estimates trend in the wrong direction, which is pretty commonplace in terms of most of the market outside of some sectors like oil and energy. So this is now baked into the cake already in terms of price. So the downward revisions also have it at a exact strength number 3 hold at the moment. So now we're going to look at some stock price movement. So the stock's up about 880% in the last 15 years, which crushes its medical product market, which is up only about 100%. This includes about a 60% climb in the last 5 years, where it's been a little choppy up and down, and it's lost all of its COVID gains to trade it around where it was in May of 2020. So Align stock is now down about 67% from its records of over $700 per share at around $238 per share at the moment. So a major pullback could offer a nice, solid, longer-term entry point. And then obviously the pullback has recalibrated its valuation as well. So it's now trading near its levels that it last saw in 2011. So the stock's trading at 23.3 times forward 12-month earnings, which marks a discount to its broader industry for the first time in a really long time. So it's been recalibrated in a massive way. As I said, it's now trading. The last time it traded anywhere near these levels was in 2011. So a really strong sign of that it might be a good long-term entry point. And once again, straightening your teeth is never going to go out of style. It might go in some cycles where people are more willing to spend on fixing their teeth, which is a still relatively cosmetic thing for most people during economic growth periods, but it's not going to go out of style. And they're now appealing to a wider range of customers. They're growing internationally. 6 out of the 8 brokerage recommendations Zacks has are strong buys with only one sell. The company also has a really strong balance sheet. It's got about $2.5 billion in current assets, about $6 billion in total assets versus just 1.8 in current debt or current liabilities and 2.2 in total liabilities, and it actually has no debt in its books at all. So really strong balance sheet, which also goes a long way during these broader times of economic uncertainty. So now we're going to move on to another company that has a really stable business model that's not going to go out of style anytime soon. In fact, it's going to get even probably more important going forward, and that is Mastercard, which trades under the ticker MA. So Mastercard is a consumer and business credit card powerhouse that operates also that elaborate back-end processing network. It's also been diversifying far beyond traditional credit cards in order to become a global payments and fintech player that's built for our current dynamic digital finance environment that's changing by the day. It's jumped into newer offerings such as buy now, pay later, cryptocurrency, and other various things. So Mastercard, alongside Visa, is also raising its interchange fees that merchants pay for accepting credit cards. So that could go away to helping the company boost both its revenue and profits. The company crushed our first quarter earnings estimates by 27% at the end of April. And the strong showing was driven by cross-border segment. So that's that travel business, which is key for lots of credit card companies. And the company said that its travel-focused segment was stronger than it even projected at the time and above its 2019 levels for the first time since the pandemic began, which is a great sign. So its 2021 revenue total climbed about 23% to outpace its pre-pandemic totals by a whopping $2 billion. And its adjusted earnings climbed 31% last year. So despite that slowing economic growth everyone's talking about and lower consumer spending and downbeat attitudes, and the higher interest rates also should help the company as well. So despite all of that, Zacks estimates call for its sales to climb 17% both this year and next to see the company pull in about $26 billion in sales in 2023. And its adjusted earnings are projected to climb 25% this year and then another 20% in 2023. And unlike lots of companies throughout many different sectors, the company's actually seen its earnings revisions trend higher for both 2022 and 2023 since they last reported, which is a positive sign, and the company's beat on the bottom line by an average of 14% in the trailing 4 quarters. This positive bottom line revisions momentum also helps it land a Zacks ranked number 2 buy at the moment. We should also note that the company raised its quarterly dividend by 11% recently, and its board authorized an additional $8 billion share repurchase program, last fall. And 15 of the 20 brokerage recommendations that we have are strong buys, with 2 more buys and only 1 below a hold. So some investors might be a little nervous about buying a credit card stock with the possibility of a recession on the horizon. But if you have any confidence in the long-term economic growth in the U.S. and beyond, Mastercard is certainly a stock to own, especially as cash really falls further and further out of favor in the U.S. and beyond. So if we look in terms of its stock price performance, the company has destroyed the market and its industry over the last 15 years. It's up a whopping 1,800% versus the benchmark index, which is up less than 200%. The stock has cooled off over the past 3 years, so it's up just 19% versus the benchmark's roughly 32% climb. And it's moved roughly sideways over the past 2 years. And the stock is down about 20% below its records and is trading at around $316 per share at the moment, at the very end of the second quarter. So the pullback has Mastercard trading below its 5-year median and not too far off of its COVID lows in terms of forward earnings. So it's trading at 27.9 times forward 12-month earnings, which is also 40% below its highs, which is a great sign. It shows that the stock has fallen and its earnings outlook is also growing as well during that time. So we're now at really, if you look back over the last 10 years, MasterCard's trading at really nice levels. It's not too far above its 10-year median of 26.5. It's at 27.8 right now. So a great sign and a great longer-term entry point for a company that's poised to thrive for years to come in our digital money world. And the last stock up on the list today is Intuit, which trades in the ticker INTU. The company joins together really two unstoppable forces that make it a strong long-term buy and hold candidate, and that is taxes and software. Both of those things are going to be dominant in the world and certainly the U.S. for a very, very, very long time to come. So Intuit operates a relatively straightforward and essential business portfolio in a cloud and software as a service market that's really crowded by the day, and people offering very similar offerings that are maybe competing directly against other people. But Intuit's portfolio is really strong, and it has a dominant player in many of its individual areas. So the company offers a variety of financial services, and it's arguably most famous for its online tax software, TurboTax. The company also sells software geared towards accounting, small business money management, personal finance, which includes QuickBooks and Mint. These platforms aren't going to go out of style pretty much no matter what the world looks like in 5 to 10 years or maybe even 5 decades, especially if they keep adapting to the technology. They've also boosted their portfolio through some pretty key acquisitions in the last year or so. So the firm purchased consumer finance firm Credit Karma back in December 2020. So that was about over 2 years ago at this point, I should say. And Intuit didn't stop there. Which Credit Karma, for people who don't know, it's if you've ever seen commercials, their company offers free credit scores and various other financial offerings geared towards individuals. The company also completed last November its purchase of email marketing powerhouse MailChimp. So the company essentially provides digital ad services and customer relationship management tools. This helps it expand into kind of a whole new area and provide a wide array of services to small businesses and mid-sized businesses, entrepreneurs that go along with its tax and other financial service offerings as well. So they paid roughly $12 billion for the company in a combination of cash and stock, and the deal is by far its largest and topped its $8 billion deal to buy Credit Karma. So it was a big bet over the last several years on these two companies, and Wall Street appeared to like those acquisitions at the time. The stock did well after those acquisitions, so that's a good sign. So the company currently boasts over 100 million customers globally across its various platforms, and it's grown at an annual revenue. It's grown its annual revenue, I should say, by 11% to 25% for the last 6 straight years. Meanwhile, its adjusted earnings climbed about 24% last year. And the company in May topped its Q3 2022 earnings and revenue estimates in late May. So the company's revenue is now projected to climb 32% in 2022 and then another 14% in 2023 to about $14.4 billion. Meanwhile, its adjusted earnings are projected to climb about 20% this year and then another 16% next year. And the firm, in a really positive sign, upped its guidance amid all of the economic slowdown fears, which shows you just how important and crucial its business offerings are in times of even economic downturns. Intuit currently lands a Zacks ranked number 3 hold at the moment, and all 13 of the brokerage recommendations that we have at Zacks are strong buys. The company also pays a dividend, even though it's still focused pretty heavily on its long-term growth, making huge acquisitions the last several years alone. The firm also boasts a really nice balance sheet, which is great. As I said, during these tough times or broader economic uncertainty, you want to own stocks at all times that have a good balance sheet, but especially during times of uncertainty. The company's shares have climbed about 560% in the past 10 years and 1,200% in the past 15 to more than double its computer software market's 520% climb. Also, the stock's still up about 45% in the last 3 years and 27% in the last 2 to outpace its software market. And that is impressive considering the stock's tumbled about 45% from its November peaks. Its price tag is still maybe a little rich for some people's blood. It's trading at around $387 per share the last time I looked. This also, though, means, and this is total speculation, that it could be a candidate for a stock split, possibly joining the likes of Amazon, Apple, Tesla, and some others to just make their stock price on its face more attractive to the average retail and individual investor. I'm not saying it's going to happen, but it's a possibility. Still, nonetheless, the stock's down 45%. It's a nice entry point. And in terms of the valuation front, the stock is now trading 53% below its highs. It's still a little rich for some people's blood at 41 times forward 12-month earnings, but it's, as I said, 53% below its highs. It's now at its median levels since if we look back to 2014, and that was when Wall Street kind of reevaluated how they were treating the company and its longer term outlook in this new world we're living in where everyone's doing these digital services. So the company kind of got recalibrated around that halfway through 2014 for various reasons. So it's now at those levels and essentially, as I said, at its median if we look back from now till 2014 and over 50% below its highs. So that's a good sign. Its valuation has been totally recalibrated. And if you're a longer-term investor trying to get into a company that operates a pretty impressive business focused on taxes, accounting, various things like that, in the software world, those things aren't going out of style. Neither are digital payments and credit cards, which is what Mastercard does, and straightening your teeth also is not going out of style. So these are 3 strong companies within 3 distinct areas of the economy that are projecting to grow over the long haul. There are both also 3 impressive companies that are entering some nice entry points if you're a longer term investor. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.